Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of everything you need to know about Dividend Reinvestment Plans, DRIPs. Ever wondered how to watch your investment grow without lifting a finger? Welcome to the world of Dividend Reinvestment Plans, or DRIPs. These plans allow investors to automatically reinvest their cash dividends into additional shares of the same stock, compounding their investment over time. The beauty of DRIPs lies in their potential to generate passive income, turning dividends into a powerful growth tool. Whether you're just starting out or looking to enhance your investment strategy, understanding DRIPs could be your ticket to a more robust financial future. As we dive in, you'll discover the key advantages and how they can fit into your own investment plan. What are Dividend Reinvestment Plans, DRIPs? Dividend Reinvestment Plans, often known as DRIPs, offer a way for investors to use their earned dividends to purchase more shares of the same company. This setup is not only convenient but can also be a powerful strategy for growing an investment over time. By reinvesting dividends automatically, investors can benefit from the compound effect, similar to watching a snowball grow bigger as it rolls down a hill. Historical context of DRIPs. The idea of reinvesting dividends isn't new. It started in the 1960s when companies decided to provide shareholders the option to reinvest their dividends directly back into company stock. This approach was a boon for both the companies and the investors. For companies, it meant loyal investors and a steady stock purchaser. For investors, it was a chance to accumulate shares without having to make manual transactions or pay hefty fees. As the years went by, DRIPs grew in popularity. Initially offered by large, blue-chip companies, they became a staple in the investment landscape. The appeal was simple: allow investors to automatically reinvest their quarterly dividends to buy more stock, often at a discounted rate and without paying commission. This evolution marked a shift towards empowering individual investors, making long-term wealth building more accessible. How DRIPs operate. DRIPs work like a well-oiled machine. Instead of receiving dividend payments in cash, investors have their dividends automatically used to buy more shares. This process requires minimal effort from the investor. Here's how it generally works. Enrollment. Investors must sign up for a company's DRIP program, often through their brokerage or directly with the company. Automatic reinvestment. Once enrolled, dividends that are paid out by the company are funneled automatically into purchasing additional shares or fractions of shares. No commissions. Many DRIP programs offer either reduced or zero commission fees, which is a great way for investors to enhance their returns by minimizing costs. Discounted shares. Some companies even offer shares at a discount to market price, providing more bang for every reinvested buck. Think of DRIPs like planting a tree that continuously yields more seeds. Each dividend is like a seed that plants itself back into the ground, ready to multiply and grow stronger with each passing season. In essence, DRIPs are a hassle-free, efficient way for investors to potentially boost their stock holdings and capitalize on the magic of compounding returns. Why let those dividends sit idle when they can be put to work, buying more of what already seems to be working, your chosen stock? Advantages of participating in DRIPs. Participating in Dividend Reinvestment Plans, DRIPs, offers numerous benefits for investors looking to build wealth over time. Understanding these advantages can empower you to make smarter investment decisions. Let's explore some key benefits of investing through DRIPs and how they can enhance your financial future. Compound growth potential. One of the most compelling reasons to engage in DRIPs is the power of compounding. When you reinvest your dividends, you buy more shares of stock without having to spend additional money. Over time, these new shares can themselves generate dividends. This creates a cycle of growth. Imagine planting a tree. Initially, it starts small, but as it grows, it produces more branches. With each branch comes new leaves and fruits. Similarly, as your investment grows, the dividends you receive can lead to even more dividends. This compounding effect can significantly increase your returns, making it an attractive strategy for long-term investors. Dollar cost averaging effect. DRIPs help you take advantage of dollar cost averaging. This strategy means you invest a fixed amount regularly, regardless of the share price. So whether the market is up or down, you purchase shares at varying prices. This approach can lower your overall investment cost. When prices are high, you buy fewer shares. When prices are low, you acquire more. Over time, this evens out your investment cost per share. By participating in DRIPs, you ease the stress of trying to time the market and reduce risks associated with price volatility. Reduced transaction costs. Another advantage of DRIPs is the potential for reduced transaction costs. Many companies offer DRIPs with little to no fees for purchasing shares. This means more of your money goes directly into buying shares instead of paying for commissions. Investing with minimal fees is crucial, especially when you're starting out or investing small amounts. Even a small fee can eat into your returns over time. By choosing DRIPs, you can maximize your investment and keep more money working for you. Tax advantages of DRIPs. Investing through DRIPs often comes with tax benefits. When you reinvest your dividends, you're not taking them as cash. This means you might defer taxes on those dividends until you sell your shares. Additionally, if you hold your investments long-term, you may qualify for long-term capital gains rates, which can be lower than ordinary income tax rates. This tax treatment can contribute to your overall returns, improving your financial situation as you grow your investment portfolio. In summary, the advantages of participating in dividend reinvestment plans go beyond just receiving dividends. They create a pathway to compounding growth, reduce investment risks through dollar cost averaging, minimize transaction costs, and offer potential tax benefits. Each of these factors contributes to a more robust investment strategy, ultimately leading to greater wealth over time. Disadvantages and considerations of DRIPs. Dividend reinvestment plans, DRIPs, can be a smart choice for many investors, but it's essential to understand their downsides as well. Each investor has different goals and situations, so consider the following aspects carefully. Lack of control over reinvestment. When you sign up for a DRIP, you're giving up some control. Typically, dividends are automatically reinvested into additional shares of stock. While this sounds convenient, it means you won't have the option to choose when or how to reinvest your dividends. Imagine you're waiting for a stock to drop in price to buy more shares. With a DRIP, you may end up buying at a higher price when your dividends are reinvested automatically. You might want to take those dividends and invest them elsewhere, but a DRIP locks you into that specific company. Does it make sense to automatically reinvest in shares that are possibly overvalued? This lack of direct control can lead to suboptimal investment decisions. Potential for overconcentration. Another issue with DRIPs is the risk of overconcentration in one company. When dividends are automatically reinvested, investors might find themselves unintentionally owning a larger percentage of that one stock. Consider this. If a company is performing well, the additional shares you keep buying can lead to a situation where a significant portion of your portfolio is tied up in just one asset. This can be risky. If that company faces difficulties, your entire portfolio may suffer more than if you had spread your investments across different stocks. Always think about diversification. When all your eggs are in one basket, it can be a bumpy ride if that basket falls. Tax implications of reinvested dividends. Don't forget about taxes, they can catch you off guard. Even if you don't see cash from your reinvested dividends, they are still taxable in the year you receive them. The IRS considers reinvested dividends as income, meaning you need to report them on your tax return. This can be confusing. You're paying taxes on income you haven't actually received in cash. This creates a situation where you might not have cash available to cover your tax bill, especially if your dividends grow over time. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.